Hi, Mike. So we've had share ramping, Robinhood, GameStop, a whole new language has crept into the news in the last week or two. Can you tell people what's been happening?
Yeah, it's a really strange things going on. So I think firstly, what's GameStop? Well, GameStop essentially is like kind of Blockbusters, but for video games. It's like, a high street retailer where people go and they buy their video games. But nobody really does that anymore. Like we don't go to Blockbusters, we don't get videos or DVDs out. We watch them on Netflix or whatever. It's the
Yeah.
same for video games. So, it's a kind of dying company, what it seems to be. And because it's a dying company, lots of hedge funds have been betting against it, in essence. So when betting against it, what we call short selling. And that's where a hedge fund or another investor makes money from a stock going down. So
Okay.
what you do to head to short a stock is you borrow some of the stock. And so let's say there's a big pension fund that holds some of the stock long term.
Yeah.
Well, they will happily lend that stock to somebody else and they get paid a little bit of interest, just like you get paid, on if you were to loan some cash to somebody.
Right.
So they lend the stock to the hedge fund. And let's say they are worth, I don't know, $100 or £100 per share. They borrow the stock and then they immediately sell it. So now, instead of $100 share, they've got $100 cash. Let's say that stock then falls to $80 a share.
Yeah.
They can buy it back at 80 for something, and they've still got that $20 of profit essentially because they buy it back at 80. They can give that share back to the person they borrowed it from, and they've got $20 of profit. They've not got 20% gain in that sort of instance. So the important thing is your loan is of a number of shares rather than a value in terms of pound notes or whatever.
Right.
So really it can get a bit technical, but the point with that is obviously as a hedge fund you only make money if the stock goes down.
Mm-hmm.
The maximum a stock can go down is 100%. It can go bust.
Mm-hmm.
If the stock goes up, you lose money. The maximum a stock can go up is actually, in theory, infinite. It can double, treble, it can carry on going forever.
Yeah.
So it's quite a risky thing to do. So what therefore hedge funds have to do is that if there's a stock that starts going up and they were betting on it to go down, then there's a point where they have to go, I need to get back, I get out of this trade. And so what they have to do is buy the stock back. So in our example before, maybe they might have bought it back when it got to 110, 120, whatever it is. It caps their loss at a certain amount, but they bought the stock back. So, it's a complicated background, but I think it's important to talk about that because what's been happening recently is a group of individual investors on a message board on social media decided they wanted to go and buy this stock. And they knew full well that a couple of hedge funds were short that stock. So they deliberately start buying the stock, which obviously pushes the price up when you start buying the stock. And what they deliberately tried to engineer was what's called a short squeeze. So in other words, they wanted to force those hedge funds to have to, start cutting their short positions. Because what happens when they cut the short positions? They buy the stock back. And therefore that pushes the price up even more. So what you get is the price starts going up and then all these people have to panic, buy it, and then it goes up even more. So you get the huge, great big, it went up, many times over this stock over a course of a few weeks. And, some hedge funds had some pretty big losses. So what's really unusual is, it's almost the opposite of what you tend to expect. You've got individual investors taking advantage of institutions, whereas usually it's the other way around.
Yeah. So hedge funds are often seen as the villains, aren't they? Is that rational?
I think it is a bit debatable. I think per se there's actually nothing particularly wrong with short selling, because what they're doing is it's only kind of the same thing you're doing if you're buying stocks. A stock market is there to make good companies, reward good companies for good investments, and to, frankly, the bad companies go bust. So it sort of almost accelerates that process. And what hedge funds have done from time to time is that they've uncovered some issues in companies that other people haven't spotted, sometimes fraud, when they've done their research, and therefore that actually picking up on that sort of thing is actually a positive for the market as a whole. So I get a lot of people don't like them. I'm not a big particular fan of them myself, but actually the short selling thing in itself isn't particularly immoral or a problem as far as I'm concerned. Okay.
Oh, thanks. Elizabeth Warren, US Senator, has been referring to this whole kind of situation as just a reminder that Wall Street is what's been going on Wall Street for years and years, and the whole Wall Street has been referred to as a casino, and now we've got this individual investors kind of taken over in what has been referred to as a David and Goliath battle. How are the stock markets reacting?
Well, I think it is an interesting one. I think Wall Street is always a casino. You've got a kind of I always think that you should differentiate between what we would describe as investing, which is buying companies that you think are good companies that are going to return profits over the long term. That's investing. Whereas speculating, betting on something to go up or down in the short term is a very different thing. So it is absolutely a casino. What's changed is that the individual investors get the chance to now participate in that in a lot more easily than they have before. Platforms like Robinhood in the US mean that you can buy and sell shares essentially for free. And you can even do options trading, which essentially allows people to get into these positions with a great big amount of gearing. So in other words, it's almost like you're borrowing extra money to invest, and that enhances the volatility. What we saw in the last couple of weeks is that because of this these short squeeze, these attacks on the hedge funds, a lot of hedge funds had to massively cut their short positions. So they bought a load of stocks back. But also because most hedge funds have got some long positions, so there are some stocks that they're betting to go up, as well as some that they're betting to go down. Because they've cut their short positions, that means their overall market exposure would have gone up. So what they've also did is cut their long positions back so that their overall exposure is back to where it was. In essence, I think that's one of the main reasons you saw in the last couple of weeks where the market fell quite steeply for no real reason over a few days, and it's actually bounced back and since then pretty much made it all back. But I do think that has really been an unusual thing, that individual investors have caused that move in the market, in my opinion anyway. That's my theory.
And we like your theories. And how have the regulator been responding, and how do you see them kind of evolving as the story does?
Do you know what? I think, as usual, the regulator is miles behind. They don't understand new technology. They don't understand social media. And it is a very interesting thing. So you've got a group of investors, in a forum, all saying, let's go and do this, coordinating together.
Yeah.
There's a very fine line between, this and market manipulation. If some professional investors were doing the same thing, in fact, what it almost has is a little bit of a smack of what we used to call a boiler room scam. So some investors buy some stocks, they buy a big holding, and then they go out and they kind of, try and get a load of other people to buy that stock, and that pushes the price up. And then guess what happens? Obviously, the original investors make all the money and they cash out at the top, and then the ones who joined later on are the ones, holding the baby. They're the ones who end up, losing all the money. I think it's very, very similar to that. I really do. And the regulators, don't really know how to deal with it. I do think at the end of the day, we'll find out that there probably was some possibly actual professional investors who started this trend off.
Interesting.
That's what I think. The other thing I would also say is, there's a saying when we talk about sort of technology, when you talk about things like Facebook, that if it's something that's free, then you're the product. And I would say the same thing is true about these free trading platforms like Robinhood, because Robinhood make their money from routing the trades through certain market makers who then do loads of these trades, and they make a tiny little profit on each one. And a lot of those trades, by the way, are hedge funds. A lot of those market makers are hedge funds. So, you know, at
It's
the
a
end of the
brand new
day,
dynamic.
some institutions ended up winning.
Yeah. Okay. So is this, Mike, a storm in a teacup that will pass, or is this kind of here to stay and the regulators maybe has to face up to it?
I think it's really interesting one. I don't know the answer. I do think, you know, it is true that individual investors have more chance and more ability now to invest in individual stocks for a much cheaper price, and so therefore, you know, that can have some strange moves on the market, and it has been already. I also think, you know, some of, you know, you end up with maybe some so-called more trendy stocks that get, you know, people really like. Tesla's the obvious one in there that's gone up many times over the last year. It's a good company, but it's probably, you know, gone up a lot further than most people would have expected, and that's because a lot of, or I think partly at least, because a lot of individual investors have bought it. They love the story behind it. So I do think there is, you know, I do think it is having an effect on markets, and it will continue. How that plays out, you know, I don't know, but it's one to watch carefully, and the regulators certainly need to watch it carefully as well.
Yeah, keep an eye on. So one last question. How, if at all, will this affect how you manage funds?
I think the answer is not really. As I said, I think you should need to differentiate between long-term investing and speculating. We're long-term investors, and long-term, what makes a difference to whether the market goes up or down, or a stock goes up and down, is whether that is a good company, whether the profits underneath the companies or the market as a whole are going up or down. So long-term, it won't make a difference. Maybe short-term, it might add to more volatility. So, you know, again, something to maybe be a bit wary of, but yeah, something to watch very closely and see how that evolves over time.
And in the Equilibrium investment team, it's just another day of business as usual.
Absolutely, business as usual. It's always an evolving thing. You've got to learn new things every day in this business, so it's just another new thing for us to get to grips with.
Great, thank you so much for your time, Mike.
No problem. Thanks a lot.